Let's talk about the big development in the markets over the course of the past couple of days. We got at least past a very large hurdle in the S&P 500, one that's been at least an overhang for quite some time. So does that mean from a strategy standpoint, we have an all-clear signal to go back into the risk markets?
No, I wouldn't consider just having moved back above key moving averages an all-clear sign. I don't think there really are many of those that exist in the market. We've seen very strong breadth and continue to see strong breadth, particularly in the large caps, much less so than the small caps. We continue to have a bias on the large caps. I just think that another reason for the rally that we've seen that's now taken us to these key technical levels is because of the loosening of financial conditions allowed for multiple expansion, even in the absence of better earnings growth. Obviously, this has been a year where earnings expectations have been sinking like a stone, yet we've seen multiple expansion, kind of the opposite of what we saw last year when you saw an unbelievable surge in earnings, yet you saw multiple contraction because we had tighter financial conditions. I just think now we've probably gotten, maybe not all we're going to get purely on a multiple expansion basis, but I do think earnings season is going to be important to see whether we are in the normal environment where the bar gets set low enough that companies can hurdle it. If not, then I think we may have some problems again.
So is that the worrisome part then, the idea that we could see this situation develop where markets have maybe got a little ahead of themselves? You mentioned those expectations. Does it mean then that earnings are even more key in this coming quarter's reporting season than they were during the last one?
I think they're key not only for this quarter because the expectations bar is now in negative territory. We're looking at consensus is for a drop in earnings to a slight degree and only a pick back up to about 2 to 3% in the subsequent 2 quarters. But I think what's just as important, if not even more, than just how companies perform relative to first quarter expectations is what their guidance is in the out quarters, and in particular, what that guidance says about animal spirits and concerns about trade policy and whether that will continue to be a hindrance to long-term investment decisions, capital spending, because that's what we really need for this cycle to continue, is to go from companies using their capital for stock buybacks and instead morphing it into long-term CapEx. The benefits that would accrue to productivity probably keeps inflation in check and elongates the cycle. But absent that, I think the cycle could maybe be a little bit shorter than what the consensus expects right now.
During the last part of 2018 and the first few weeks of 2019, there was an increasing amount of chatter, not just among economists, but also strategists as well, about the idea that the likelihood of a recession was increasing. Not that it would happen, but that there were odds that were at least getting better for a recession to occur sometime either late this year or into next. What is your feeling? Is the economy due to slow down sometime in the next 12 to 18 months?
Well, the economy is already slowing down, certainly relative to the fairly blistering pace of the second quarter of last year, which, by the way, more than a percentage point of that 4.1% growth was soybean exports. So that just tells you that there was a lot of activity that was essentially front-running the tariffs. And that was unlikely to persist, which it hasn't. You've got different nowcasts, GDP now, whether it's Atlanta Fed, New York Fed, for the first quarter. In the case of Atlanta Fed's GDP now, which is the most widely followed, you're only at about 0.4% growth, which on a real basis is quite weak, obviously. So we're already seeing a slowdown. And by the way, we have 100% odds of getting a recession at some point. They always happen at the end of a cycle, so that there's nothing bombastic about that comment. It's just a question of the length of runway between now and the next recession. I think absent a comprehensive trade deal, I think the runway is a little bit shorter. Getting a comprehensive trade deal, and by that I mean truly comprehensive, kind of tackling the most egregious things that were sort of the purpose of this, intellectual property theft and focus on state-owned enterprises. Absent that, and if you don't get that revival in animal spirits, then I think the runway is a bit shorter.
We talk about 10-year Treasury note yields right now, currently hovering at just around 2.59%. Yet the equity markets try to reclaim these higher levels that we haven't seen in months now. Is there a discrepancy, a dislocate between the bond markets and the equity markets right now in your mind?
Well, not necessarily. If the reason for the pullback in yields is not because growth is going to sink like a stone, but we've got inflation staying in check, then that's also a good environment for the stock market. So you'll see adjustments happen in terms of the correlation between bond yields and stock prices. Clearly, this has been an environment where you've seen an inverse relationship, lower bond yields, higher stock prices. That, of course, could change if the bond market is wrong on the inflation call. And I think there is some short-term risk that we could see inflation run a little bit hotter. That may be exactly what the Fed is looking for, but the question is, how does that sit with an equity market that I think has built in an assumption that inflation is no risk at any time in the near to medium future? So I think that may potentially represent a risk if we continue to see tightness in the labor market and it starts to filter into core inflation. Absent that, and especially if we can see a continuation of the productivity boost, if we can see labor force participation kick back in, you've got that as a force that would keep inflation in check but allow the economy to grow and extend into the next part of the cycle. That would be longer term good news for the equity market. I just think the sweet spot, the diameter of it is just a bit narrower than it was, say, a couple of years ago when the Fed first started tightening policy.
We've got just a few moments left here. You mentioned the Fed. No fireworks expected generally from Wall Street this week with the Fed meeting, but is there anything that keys in on what you're looking for out of the Fed and its policy going forward?
So I think what everybody is focused on is the changes to the so-called dots and the likelihood that they come back down closer to where the market has been. My guess is they don't come all the way down to where the market has been, but they narrow that gap with the market not expecting anything. The Fed may be moving down to one hike expected for this year. I'm not sure that's a big needle mover, but also to see what they say about any potential long-term change to how they think about inflation, maybe moving to price level targeting where they want to let inflation run hot for a while. Don't know how the market's going to digest that.